We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today again is Danielle DiMartino Booth, CEO and Chief Strategist for QI Research, former Fed insider, and also the author of the book Fed Up. Thanks for joining me today, Danielle. How are you?
Good to see you, Tom. How are you?
Excellent. You know, Danielle, we're always focused on Powell and what the Fed is signaling to the markets. And we always discuss this with you because of your unique background. So as we recently had another Fed meeting, is it more important that they are maintaining the illusion or this narrative at this current time of higher for longer to signal to the markets? And is there really a material difference between, as you have put it, talking up rates without talking up rates?
So for any household that maybe gets a great job or thinks that there's a good job opportunity halfway around the country, it matters that rates are a lot higher than when they locked in their mortgage. The same situation goes for any commercial real estate developer who needs to refinance, and we're seeing more and more of them walk away from their buildings. And the same matters for any corporation that needs to refinance their debt, and Uncle Sam as well, the U.S. government. So it doesn't, the level of rates is really irrelevant at this matter. At this juncture, we might maybe see another rate hike theoretically between now and January. But I don't think anybody is really using that as their base case, but it's irrelevant. They're much higher than they were. And Jay Powell's goal is to keep them higher than they were for longer than anybody would expect. He's only got about 4 months left to go before he has maintained a higher for longer stance than his hero, Paul Volcker. Mm-hmm. So when you go back and compare the tightening cycle that started when Volcker began raising interest rates, and when you chart the two of them, it's one of our favorite charts. When you chart the two of them, he's only 4 months out from surpassing how long Volcker really held steady at that tight stance.
So even if we get, let's say, 100 basis point cut from, let's just call it 5% to 4%, is that still a monumental gap for most of these corporates and households to need to roll over old debt loads that were originally financed at a much lower interest rate level?
It's hugely important for any entity at all of any kind that's cash flow constrained. Mm-hmm. And I keep trying to reiterate to people who are saying student loan repayments don't matter, and I keep saying, well, what if you're 35 years old and when the pandemic hit, you moved out of the city where you used to take public transportation to get anywhere you needed to go. So what if you're that person who moved out to the suburbs? So you've got a mortgage for the first time in your life, which is an obligation. You've got property taxes. You've got homeowners insurance that's going through the roof. And by the way, when you moved out of the city, there was no more subway. You couldn't take public transportation anymore. You had to buy a car. So maybe you've got your first car loan. And, as a buddy of mine, Mike Green, says, there are a lot of car payments right now that are lower than people's car insurance payments every month. And it's just reality right now because there are so many Americans driving the roads without any insurance that the people who are insuring their cars, they have to subsidize the others. And replacement costs on vehicles have never been this high. So what if you're that theoretical person and you make more than $60,000 a year, which you obviously did because you could afford to move out to the suburbs, get a mortgage, and finance a car. So you don't qualify for forgiveness for your student loan payment. But what if you're already cash flow constrained and God forbid your boss has said, hey, I'm Amazon.com. You have to be in the office for a certain number of days a week. So that home office you've got out in the exurbs, God knows where, that's no longer relevant and you're overpaying for it. Mm-hmm. And, your property taxes have gone up. So your actual mortgage payment's gone up, even though your mortgage rate might be 3%. None of it really matters if interest rates are at this level and you need out and you're cash flow constrained. It's a problem.
Mm-hmm. Yeah, it's just that ultimate level, not necessarily the particular number that we're worried about. Danielle, considering the likelihood of a recession in the coming months, how do you think about the actual definition and any indicators that you watch to understand where the economy is in this respect?
So if you look at disposable personal income, that's what we were just talking about, right? The cash you have on hand. And if you adjust that for inflation, it's negative. So in an economy that's 70% consumption, that's a problem. And the fact that we're not going to have any fresh new forms of stimulus checks from the government until March 2025 at the earliest, after the next election comes and goes. I mean, my goodness, we just witnessed 3 solid weeks of not being able to choose a Speaker of the House. Mm-hmm. So you'd be hard pressed to find anybody in America right now who would say, hey, that House of Representatives is going to give away money, cash before the election. I don't see that happening. So what I'm following the most closely right now is the pace of layoffs, the pace of closings. We've just had Rite Aid went out of business. Z Gallery, a furniture retailer, went out of business. And that was like 500 stores here, 20 stores there. I read yesterday one headline that a hospital was that in the past few months, 65 hospitals in the country have either closed divisions or shuttered units. The maternity ward's gone. So there is a lot in the way of job loss right now. And as we know, a lot of the job losses have been front-loaded in high-paying positions. Mm-hmm. That's, again, a problem in an economy that's 70% consumption.
Mm-hmm. So does that really account for, let's say, the non-farm payroll numbers? Are those a very important metric to be watching that gives us a semblance of truth and what's actually happening?
So here's the deal. Prior to the current administration, let's say you're General Electric or IBM, and you were going to lay off 50 people in the state of Maine and 50 people in the state of Washington. Well, by the old rules, you didn't have to file what's called a WARN notice, capital WARN, WARN notice with the state, because you hadn't breached the 100 job threshold in that state that required you to give your employees 60 to 90 days of severance. A WARN notice means you're going to pay them for 60 to 90 days while they look for work. Well, the current administration is now requiring companies, if it's IBM and there's 50 employees here and 50 employees there, the current administration is making you still file that WARN notice. Mm-hmm. So we have a lot of Americans who know they've lost their jobs and are collecting severance. So if the Bureau of Labor Statistics gives them a call at home and they pick up and they're asked if they have a job, they're going to say no. If the Bureau of Labor Statistics, in creating the other survey, the non-farm payroll survey, calls the company and the company is still paying that employee, they're still technically on the payroll, the company's going to say, yes, this person's employed. Mm-hmm. So people ask me all the time, why is there this big disparity between the survey that creates the unemployment rate, which has continued to go up, and the survey that creates non-farm payrolls? And, now that I've learned this intriguing nugget of information, we actually can fill in the blank mm-hmm. in terms of why there's this big gap and why non-farm payrolls is a heavily inflated number. Doesn't matter for the stock jocks. That's what they follow.
Right.
But it doesn't matter. And they also see that, continuing, that initial jobless claims are only 210,000. Okay. Well, we know that yellow trucking was 30,000 alone. They're in the middle of severance. There's a pig in the python is what I'm trying to say. Mm-hmm. And we're going to see it.
And I think that speaks towards the idea of these long and varied lags. That obviously, that artifact of that data really adds to that as well, right?
Well, we didn't used to have such long and varied lags in the payroll data, but we certainly do now. Mm-hmm. And they're also only getting, in the latest payroll report, they only had a 39% response rate at the first go round. So, if you're only sampling 39% of the companies in America, you're not going to get the full picture. And that's why we've seen so many downward revisions to the data, mm-hmm. with the exception of July and August, where we saw positive revisions to the data. fully in government jobs. Private sector revisions were negative.
Mm-hmm. Yeah, I mean, that goes back to the point that you made to me before we hit record this morning. This looking at the revision of data is getting tiring, right?
It's exhausting. Whether every time we get industrial production, which is one of the determinants of recession, it came in stronger than expected. Oh, but last month was revised down. Mm-hmm. Negative, by the way. So it is really, there's something weird going on in, when home builder sentiment is cratering and the Census Bureau tells you that new home sales were through the roof, you're like, wait a minute, something doesn't line up here.
Mm-hmm. Danielle, I remember speaking with you in one of our previous interviews about consumer credit card debt reaching a new high of $960 billion. And that has only continued to climb. And, we're up over $1 trillion easily now. So with all of these negative data points, how does the Fed continue to really stick to this narrative that the consumer is strong?
Well, it's interesting because if you look at credit card rates, it's kind of like prices at the gasoline station, right? They come down with a long and varied lag compared to West Texas intermediate crude prices. Mm-hmm. What's interesting when it comes to credit card rates, though, is that they're at the highest they've ever been. So credit card lenders have taken the opportunity of higher interest rates to raise borrowing costs. But even before the Fed went on this campaign of terror, they were still double digits, 15, 16%. Now they're just closer to 30. Mm-hmm. What I'm saying is if you're not pristine, if you don't have a pristine credit rating, it's likelier than not that you're going to be paying a very high credit card rate, regardless of what the Fed does. Mm-hmm. The problem is that people have run up so much credit card debt now, and there's nothing they can do to unring that bell.
Danielle, there was a narrative that was going around, let's say a year ago, that the wage price spiral was something that was going to continue to drive inflation and drive prices higher. Is that completely broken now because of many of these dynamics within, the employment market?
Well, we kind of got a hint of that a few months ago when Walmart came out and said, we're lowering salaries across the board for starting new employees. They're like, okay. And then if you look at the Atlanta Fed wage tracker, a year ago, when there was all this chatter about the wage price spiral that's somehow gone silent, a year ago, there was a really big difference between somebody who was job hopping. So they called them job switchers. Mm-hmm. They were making multiple percentage points more. I think, actually, I've got the numbers in my head. At the peak, job switchers were seeing wage gains of 8.3% year over year, and job stayers, as they were called, were making 5.9% raises. Both of the gap is closed and the number's fallen to 5%, and it continues to fall, which is that's what you see when companies are conducting layoffs, when companies are going bankrupt at the fastest pace since 2010. Bankrupt means a lot fewer employees mm-hmm. and a lot more supply of labor, so that you don't have to pay up anymore.
Mm-hmm. So what do you see as the path forward for inflation here? With oil continuing to stay high, and, I spoke to your friend David Hay last week. We touched on the supply of oil really being at a tipping point of coming down in the US. Does that really exacerbate the costs across the board here?
We certainly have US households in a tight spot. Global demand for oil, Europe's basically in recession. So global demand for oil is acting as a governor. So for all of the predictions that oil prices are going to become problematic, they're high and at a high level. I don't see much justification for them going much higher because we've had a collapse in demand for gasoline. Mm-hmm. And what does that tell you? It tells you that households are having to cut corners. And you can read any number of stories that say, I'm driving fewer errands. When I go out, I make a laundry list of what I need to do while I'm out. And I'm deliberately driving less than I was before. So that's what happens when wage gains don't keep up. And what that means is that companies' pricing power is really getting hurt. And that's kind of what stagnation, stagflation feels like. My buddy Ivy Zellman put out a report a few days ago about apartment operators. And the only two cities in America where apartment operators are able to raise rents are Chicago and Philadelphia. And that's mainly because they weren't swarmed with apartment developers when the pandemic hit, because they have really high crime rates. But in every other city in America, major city in America, right now, rents are falling. And why is that? It's because if you've got to spend this much money at the gas pump and your budget's not growing, that means that you have a finite amount of income. And if you got to stretch it further at the gas station, that means you spend less on other things.
So does that really, I guess, highlight the idea that everything in the economy starts with freight costs, and those costs affect every other portion of the economy?
They do. And, it looked like in January that we were going to come out of the freight recession. My buddy, Craig Fuller over at FreightWaves, he does a great job tracking all the metrics. And it looked like after the debt ceiling was resolved that we were also going to kind of try and crawl out of the freight recession, and we've fallen right back in. And that tells you that the holiday shopping season is not going to be that good, or there'd be a lot more railroads, trucks, trailers, what have you, helping to stock up. And what we're hearing from one company after another is we thought by now that we would see our clients restocking, and we're not.
Which I think I've heard you talk about a stat of FedEx lowering prices. I think that's a perfect example of that, right?
I look, FedEx lowering prices going into the holiday season it's like the world's turned upside down. But they're saying it's because we are looking over the horizon and we don't see the demand that we would normally see during a holiday season. UPS, they just reported very disappointing results. And it's hurting right now that volumes are down, but they're paying their employees more because the strike was successful.
So when we think about all of the factors where consumers are really getting, let's say, squeezed by these higher rates, are the subprime auto loans another great example of this issue really starting to manifest itself in the real economy?
Yeah, so the car situation is really problematic. People had inflated FICO scores during the pandemic because they didn't have to pay their rent, they didn't have to pay for their car loan, they didn't have to pay their student loan, they didn't have to pay anything. They were getting $2,500 extra a month when the CARES Act was passed. So people's FICO scores dramatically improved. They were able to borrow more than they would have otherwise. And now we're seeing the fallout, and it will not be contained to subprime at all, because of the example that we started with, right? The 35-year-old person who moved out of the city. They've got a lot more financial obligations than they used to have. They might have bought a used car that they don't want to spend money or can't spend money repairing. And what we're hearing from the repossession industry is that they're constrained because they don't have enough employees. So if they had more employees, they would be able to repossess more cars, but there was no need for people repossessing cars when people didn't have to make their car payments. So it's a bad situation, and it's getting a lot worse. Ask Capital One Financial that stepped away from even making car loans in June of 2022, and yet they're writing off tons of bad car debt. And same with the biggest three banks. They're really, really taking big charge-offs in the auto arena. And I think this party's just getting started because it was only October that we saw the resumption of student loan payments, and it's not until November that a lot of Americans who took advantage of extensions to forbearance for their mortgage payments. It's not until November that some Americans are going to have to make their first mortgage payment since March of 2020. So this party's just getting started.
Yeah, it seems like there's just, in a way, a perfect storm of many things kind of lining up. And as you said before, there are not going to be any more checks issued to the average consumer until 2025, right?
Yep, that's right. And that's assuming you get, a massive progressive wave where they look back at 2020 and 2021 and the huge inflation that was created by handing money out like candy. But you've got to have people who can look the other way and forcibly push inflation rates back up. It'll be like Peter Schiff's dream come true.
Well, Danielle, coming into an election year, and of course, politically, it's always an important point to have the economy doing well after your last term. How much pressure do you think Powell will come under if we do start to see this credit event really start to negatively affect markets and the economy here?
Look, he's the perfect fall guy. People can, politicians are going to go after him saying, you're the one who created this recession. You are the one who created all these bankruptcies. So it's on you. And by the way, the Federal Reserve has a dual mandate. One of them is to maximize employment. You're not living up to your mandate. You're not doing your job, Jay Powell. He's going to be the best person to hang out to dry in 2024.
So with that being said, do you think that it's a possibility that Powell actually resigns before ever stepping away from this rate hiking cycle?
I mean, I could be wrong. I don't foresee it, but he chose to take 4 more years on, not because he needed a bureaucrat's pension for life. The guy's net worth is north of $100 million. So he's not in the job for the benefits. He's there to make a difference and to do right by his country. And if he manages to break the symbiotic relationship between Wall Street and monetary policy, he will have succeeded. He's going to break a lot on the way. But if he can get rid of the so-called Fed put, that's a powerful legacy.
And as you said, he's only 4 months away from the best comparison to the legacy that he wants to have held, right? So that's obviously going to be really important. And his legacy is very important as well.
It is. But again, the reality is he's going to be attacked. And, we don't know right now because monetary growth is in contraction and the Fed's not buying any treasuries right now. We don't know how long liquidity is going to be sufficient and whether or not it'll be practicable to continue with quantitative tightening. He seems to think and hope, and his chief lieutenant, Christopher Waller, they seem to think that they can continue shrinking the Fed's balance sheet through 2025, even if they're lowering interest rates. But it remains to be seen because you can never tell when there's going to be a break in the financial system. But we know that a lot of money has been rolled off of the Fed's balance sheet and that has manifested in a major default cycle.
Well, you mentioned the word liquidity there, Danielle, and I think that's going to be really important at this time. Do you think that with this credit event that we are foreseeing as a major issue that really has yet to be manifest in a major crash in some way, shape, or form, is the worst case for Powell to see a drying up here of issuance of high yield debt?
That's the ultimate boogeyman. And that was what compelled him to do a 180-degree turn in late 2018. It wasn't that the stock market was melting down. It was that the stock market was melting down because there were no high yield bonds sold for 41 days. That's a record. There was a time earlier this year that we had 25 days in a row with no high yield bond issuance, and the markets were really getting nervous. But it's come back. It's come back to a trickle, very, very low. But we have not yet seen a late 2018 event. Yet. That is the one thing that would really that would make Powell step back and get really nervous is a lack of high yield issuance.
So if we get, let's say, a 20% drop in the S&P with a continuing trickle of issuance of debt, is that the best case that Powell could see?
Well, that allows him to stay higher for longer. And you end up having more private equity firms backed into a corner, because if high yield issuance is slowed down to a trickle, that means that it's even more difficult for a lot of private equity firms to access liquidity. Mm-hmm. And we forget that the non-banking system is $240 trillion globally. That compared to the conventional financial system, the conventional banking system, that's 180 trillion. So he's really trying to get at the larger financial system, which is the non-banks, and it's a more difficult task because they don't have to report to their investors, as we see in a stock price that's trading every day on the New York Stock Exchange. Price discovery can wait for years at a time unless Powell holds his ground. Mm-hmm. And then you have a problem if you're in the non-banking sector.
Mm-hmm. Danielle, with two conflicts going on right now, far from our shores, many people domestically struggling, does the public really start to question how much monetary aid is being sent overseas? And how do you think that discontent starts to manifest?
Well, we've certainly already seen quite a bit of public agitation with kind of the sense that a lot of money is being thrown at Ukraine, but not a lot is happening in terms of results. You know, is this another Afghanistan? Is this another Vietnam? I think the situation with Israel is much different and should be viewed differently. But you are absolutely correct that the public is dismayed that there's not more being pumped into the domestic economy. And what is being pumped into the domestic economy tends to be what some would characterize as woke. So it's, you know, and even so, you've seen Ford and General Motors walk away from electric vehicle major investments mm-hmm. that they were going to make. Even if you're complying with the government, if you can't make money doing it, you're not going to do it.
Do you think it's a possibility that the union pressure that we saw as part of the negotiations there affected part of that decision as well for them to step away from the EVs?
Oh, absolutely. This was a great excuse mm-hmm. For them to say, we're losing billions of dollars because of this. I mean, I think one estimate right now is that General Motors has lost upwards of $4 billion because of this strike. Now they're going to inflate that number for sure. But yes, of course, it's been used as reason to step back. Mm-hmm. The public's not paying up. The public is not paying a premium for electric vehicles. And that's just reality. Ask mm-hmm. Elon Musk.
Yeah, absolutely. I think the appetite for EVs for most of the people that were willing to pay a premium for them has been used up and is now back down to, let's say, the reality of those that those vehicles make sense for that segment of the population.
Yep, absolutely. Mm-hmm.
Danielle, of course, we're speaking here towards the tail end of October. We've got just over 2 months left until the end of the year here. What are you keeping an eye on to really understand where these markets are headed, whether it's the debt market, whether it's the repo market? Is there anything in particular that you're really trying to keep an eye and a pulse on?
So I'm trying my best to follow the level of bank reserves and whether or not that's going to be problematic going forward. That is, of course, what triggered not QE mm-hmm. in 2019. So if you start to see the funding markets seize up, I think that that's going to be a huge red flag. And you mentioned we're going into the end of a year. If a lot of companies were on the brink or on the edge of filing, now is the time. Mm-hmm. And if you're going to reduce your payrolls and try and make your fourth quarter earnings look better than your third quarter earnings, you know, the companies that have surprised are the ones that have been the most aggressive with cost cutting. And cost cutting is a polite way of saying layoffs. So I think you could see a snowball effect into the end of the year. And to repeat myself for a third time, in an economy that's 70% consumption. Mm-hmm.
Absolutely. Excellent, Danielle. Well, as we wrap up here, is there anything else that you'd like to leave our listeners with today?
I think now is the time to take a good hard look at your portfolio and ask yourself how long you want to be in the workforce. Because we're at a very unique juncture in which you can get paid a decent amount on your cash to sit on the sidelines and watch whatever's going to come to pass. Mm-hmm. So it's again, right now, you're not being paid as investors to take on credit risk, and you should bear that in mind.
Mm-hmm. That's a great point, Danielle. Of course, if anybody wants to learn more about you guys and your research, that's available at qiresearch.com, right?
It is. Or if you want to come straight to Substack, DiMartinoBooth.substack.com. Love to have you as a client. And if you don't follow me on Twitter, please do, at DiMartinoBooth.
Wonderful. Thanks so much for your time today, Danielle.
Thank you for having me again.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.